The week the silver suppression broke. How Black Friday and Cyber Monday sparked a historic melt-up. Every asset class has a point where history catches up to it. For silver, that moment arrived between Black Friday, Nov 28, 2025, and Cyber Monday, Dec 1, 2025, a narrow, illiquid, holiday-thinned window when the entire 60-year architecture of price suppression finally cracked. Not a rally, not a squeeze, a mechanical failure. What happened in silver over those 72 hours will be studied for decades. The signs were there, the tremors were obvious, the mismatch between physical and paper was growing impossible to hide. People I know, seasoned, serious investors, some of whom never touched metals before, have spent 6 straight months feverishly buying silver, both physical and paper, sensing that something massive was building beneath the surface. This weekend, the surface broke. One Friday morning, the traders went home, and the margin clerks took over. Thanksgiving Friday is the most underrated accident zone in all of finance. Here's who's not there: A-team traders, senior risk managers, veteran market makers. Here's who is: C-team replacements, D-team trainees, risk-averse margin clerks. The margin clerks are the most trigger-happy humans in any financial institution. They aren't there to trade, they're there to contain damage. That's why markets often break on holiday Fridays. There's no adult supervision. But this Black Friday was different. Instead of the usual engineered silver dump, the bots tried to briefly, and then something snapped. Every sell wall dissolved, every suppression attempt failed, every algorithmic shove lower got absorbed instantly. Silver ignited from $53 to over $56 in the most illiquid moment of the year. That's not normal volatility, that's control slippage. Once the bots lost control, the clerks had no authority to intervene. They simply pulled margin on exposed shorts. And the shorts had no liquidity to cover. The first domino fell. The two-star coins were tuned to why Black Friday was nitroglycerin to the suppression scheme. Silver has lived under a manufactured ceiling since 2011, but the pressure beneath the lid has been rising non-stop. The big structural failures were already in motion. 1. Industrial demand went parabolic. Solar EVs, defense, data centers, high-tech manufacturing. Silver's burn rate isn't linear, it's exponential. 2. The physical market broke from COMEX reality. For 6 months, people I know have been reporting delays, shortages, price spreads, and a growing inability to acquire significant quantities without premiums. This is classic market disconnect behavior, the prelude to a breakout. 3. The short positions became dangerously overstretched. Commercial shorts were sitting on an overloaded spring. Holiday liquidity plus exhausted selling algorithms. Entire disaster. Once silver crossed $55, the bots didn't just fail, they froze. That's the point where suppression stops being a strategy and becomes an engineering flaw. 3. Friday's breakout was a commercial signal failure. Keith Neumeyer warned about this for years. One day, you'll see a commercial signal failure. It will be sudden, disorderly, and irreversible. Friday matched his description with eerie precision. Silver didn't grind up. It blew past resistance levels that had held for years. There were no long wicks, no retraces, no engineered fade-outs, no smashdowns, just a relentless, vertical melt-up. That only happens when the suppressor runs out of ammo. Friday wasn't buying pressure, it was the absence of selling pressure. It was the first pure, unmanipulated price action silver has experienced in over a decade. For 30 years, people have said, one day they'll lose control. Friday was that day. 4. Monday, the melt-up continues. $60 is no longer resistance. Here's where the story becomes historic. Usually, after a Black Friday spike, Monday is the beatdown day. Not this year. Instead, silver opened strong, stayed strong, and surged further, hitting 58 plus, pressing for $59, and brushing right up against $60, which is the biggest psychological barrier since $50 in 2011. This is what a true breakout looks like. Follow through buying shorts covering into strength, fresh capital inflows, foreign demand responding to currency weakness, industrial consumers, panic stocking funds, rotating out of bonds and into commodities. Every element of a classic phase transition appeared in one session. Monday confirmed what Friday revealed. The suppression regime has lost operational control. The 5, the 11-year cup with handle, the technical breakout. No one believed Chris Urfel pointed it out first, and he was right. Silver formed an 11-year cup with handle pattern. That is an extremely rare formation at this time scale, and when it breaks, it doesn't target $5 higher. These breakouts target multiples of the previous range. The depth of silver's cup is roughly $20, from $30 to $50. Multiply by 3-4, and you get $120 silver minimum technical projection. This says nothing about monetary panic, sovereign debt crises, industrial shortages, ETF decoupling, geopolitical stress, currency instability. Those are multipliers. 6. Armstrong's ECM and March 14th, 2026 Pi target. The next dominant turning point in Armstrong's ECM model is March 14th, 2026, a Pi cycle date. Armstrong's arrays, as always cited carefully, suggest weakening dollar into 2026, sovereign debt acceleration, European political monetary risk, a potential commodity phase transition, capital flight into private assets. When confidence in government debt breaks, capital flows into tangible private assets, not because they're inflation hedges, but because they lie outside political risk. Silver is the purest outside money accessible to regular people. Once the ECM shifts global confidence away from public assets, silver stops trading like a commodity and starts trading like a monetary reserve, a system hedge, and a confidence indicator. That's when the real move begins. 7. How high silver can go. 3 scenarios. Let's outline the 3 trajectories that matter. Scenario 1, realistic, based purely on technicals plus demand, $90–$120 price range, based on cup with handle projections, plus a normal industrial boom cycle. This requires no crisis, just the normal rebalancing of capital flows. Scenario 2, Armstrong model alignment, confidence shift. The ECM suggests bond market instability, declining trust in governments, capital concentration into private stores of value. Under that capital flow regime, silver could overshoot to $180–$300. This is fully within historical behavior for a market exiting a multi-decade suppression regime. Scenario 3, full chaos scenario, suppression failure plus supply shock. Consider Mexico political instability, cartel conflict spilling into North American mining, Canadian output, interruptions, solar, EV sector, panic, COMEX, delivery stress, ETF sourcing failures, geopolitical currency, volatility. Under that cluster of risks, silver could spike temporarily up to 300–600 plus. Not sustainable forever, but absolutely possible in real panic, and we are closer to such a cluster than Wall Street wants to admit. 8. Purchasing power. The question that actually matters. This is the key issue everyone misses. If silver hits $100, $150, $300, does purchasing power rise or just inflate? Answer: purchasing power rises dramatically. Here's why. 1. Silver rises in monetary crises faster than inflation. Always has. 2. It benefits from lack of faith, not price levels. Loss of confidence is the ultimate driver. 3. It is outside the government financial system, completely outside. 4. Capital flows amplify price more than CPI does. When money flees public assets, silver becomes a vacuum. This is what Armstrong calls the public versus private wave, and we are deep into the private wave right now. 9. The physical market cracks were obvious for months. For half a year, people I know have been telling me they can't find meaningful quantities of physical silver. Dealers are quietly rationing, premiums fluctuate wildly, junk silver gets cleaned out instantly. Auctions behave erratically. Buyers are bidding up inferior forms just to get ounces. This is the pre-break environment you see right before a suppression failure. It's identical to gold in 2008, Bitcoin 2013, Bitcoin 2020, oil in 2007, silver in 1978. A physical premium is the early warning alarm telling you the paper market price is fraudulent. That alarm was blaring all autumn. 10. The next 60-90 days, what comes next? Expect persistent upside volatility. Even pullbacks will get bought. A short covering cascade. Friday and Monday were only the appetizer. Industrial consumer panic. Solar and EV manufacturers cannot risk being short silver at these prices. Bond market instability feeding metals. This is the big one that no one is prepared for. Foreign capital inflows, particularly from Europe, the weakest link. ETF structural stress that alone could send silver to $75–90. A potential COMEX delivery scare. This would be the fuse for triple-digit silver. Conclusion: Friday broke the system, Monday confirmed it. The silver market didn't go up, it escaped containment. Black Friday was the first uncontrolled move. Cyber Monday was the confirmation, a follow-through rally in the face of every attempted suppression algorithm. This is how suppression regimes collapse, slowly, then all at once, then violently. We are entering the all-at-once phase. People close to the market have been loading up for months, not because they are speculators, but because they recognized the quiet death of the suppression system. Now the death is no longer quiet. The world is about to hear it. To understand the cycles behind this moment, the ECM, Pi dates, sovereign debt unraveling, and the real forces driving capital into private assets, read the Armstrong Economic Code. The code explains exactly why silver is breaking free and why it's only the beginning. Settings. Add clean subtitles with no outline. Use my voice for the narrator.